From New York City's for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, central bankers gather in Wyoming for the Jackson Hole Economic Symposium, with all eyes turning to Fed Chair Kevin Warsh's keynote speech tomorrow morning. The latest inflation print shows prices rising in line with expectations, giving the Fed some breathing room to hold rates steady, at least for now. And increasing demand for corporate debt suggesting supply fears may be overblown, with blue chip bond sales setting a third straight monthly record in August. We begin with the big issue, investors bracing for Fed Chair Kevin Warsh's remarks tomorrow.
Fed Chair Warsh has indicated, sort of current data is more important than trying to predict future data.
I don't expect that all of a sudden a tight-lipped Chairman Warsh is going to, start doing his Jerome Powell impersonation at Jackson Hole this week.
He will have to deliver something that is clearer than what he did at the July press conference.
He's going to have to use this opportunity to talk more big picture.
If he gives any indication of a real commitment to keeping a lid on inflation, I think that would be very well received.
The best thing that he can do is to give some type of reaction function.
He's been telling us to let the bond market do the work for him.
If Kevin Warsh comes out and says, look, we're watching the back end of the curve, I think that's interesting.
We are expecting a clearer message from Warsh, I should say, that will help anchor those longer term yields.
There's reasons why yields have moved higher this year.
We've seen over the last few years even kind of concerns bubble up in the Treasury market.
The turbulence will be rough, so you got to fasten your seatbelt.
All right, we're going to get to the Fed and inflation in just a moment, but any discussion on rising prices directly involves the consumer, whose spending is the single biggest driver of U.S. economic growth. And data from the Conference Board this week showed consumer confidence, which is the blue line here, slumping to a 7-month low. That's a sign that high gasoline prices, along with a slowdown in hiring, continue to weigh on households. Your white line here tracks consumer expectations, and you can see there's a downturn there as well, with consumers more negative about future job and income prospects. That is the backdrop as central bankers gather at the Jackson Hole Economic Symposium for the rest of this week. Our Michael McKee caught up with Kansas City Fed President Jeffrey Schmidt, and here's what Schmidt said.
There were some of my colleagues dissented at the last meeting, so I would probably put myself in that camp. But here again, there's really good arguments on both ends of this policy decision. So let's get a little bit more data. Let's see what the task forces are going to say over the next successive meetings. Maybe there's a bit of a reset that we have to make. But for me, I think we're a little on the accommodative side.
All right, let's bring in our international economics and policies correspondent, Michael McKee, right now. He joins us live from Jackson Hole. Mike, Jeffrey Schmidt said, let's get a little more data. We got data from NVIDIA yesterday, bullish guidance, and indicated growth is being held back by supply bottlenecks. That plus the latest inflation print, July PC, what does that signal about the path of inflation?
Well, it does tell you that there are inflation issues still out there. And there's a lot of concern among central bankers, not just here, but in Europe and in Asia, about the cost of the materials going into these AI data centers and their shortages leading to higher inflation. So they're keeping a close eye on that. It is definitely the issue in the foreground here, not the topic of this conference officially, but everybody wants to know what Kevin Warsh is going to do to fulfill his promise to bring down inflation to 2%. So I would think he probably is going to have to say something, but my guess is it's going to be along the lines of further guidance rather than forward guidance, since we know he doesn't like that.
Absolutely. And of course, at the same time, we have Treasury acting to make sure that yields don't go up any further. The 10-year yield obviously matters more to consumers and the economy, but everyone's really fixated on the 30-year yield. And Scott Bessen's announcement that Treasury will increase buybacks of long-term debt has led yields to come down. The 30-year yield is now below 5.2% from above 5.3%. The 10-year yield is also lower. Is that a sign that Bessen's gambit is working?
It's working in a short-term way. That's what happens when you have interventions in the markets, in currency markets as well. You introduce two-way trade into the conversation, and people who have always been buying on one side have to realize that they can lose, and that that's what happened in this case. But the fundamentals that the market sees in terms of the U.S. budget deficit, in terms of inflation, and a number of other issues tell them that interest rates should be higher. Now, ironically, the problem for Mr. Warsh is that Scott Bessent's move is making it harder for him. Warsh would like to lower rates, and to do that, he might be able to do that by raising short-term rates, and then long-term rates will come down after the market decides the Fed has more credibility. But since the Treasury Secretary is already manipulating rates on the long end, that just makes it that much more difficult for him to sell that to the other members of the committee.
All right, Mike, thank you so much. Mike McKee joining us live from Jackson Hole. We're going to check in with him later on in the hour. Let's dig into markets now. This week, Ann Walsh, the CIO of Guggenheim, says she sees an entry point into treasuries.
If we see 5% on treasuries on the 10-year, I would tell you that is a buying opportunity. The 30-year, however, historically has traded much more on inflation concerns. I don't see us going to 6% on the 30-year, and if it does, I would take the opposite view and I'd back up the truck, and I'd buy a lot of 6% 30-year treasuries.
All right, let's dig into all of this with our roundtable. I want to welcome Kelley Gerrity, Managing Director and Fixed Income Strategist at Morgan Stanley Investment Management. Also with us is Noah Wise, Senior Portfolio Manager and Head of Global Macro Strategy for the Global Fixed Income Team at Allspring Global Investments. Welcome to you both. Let me start with you, Kelley, because I mentioned to Mike that since Secretary Bessent's announcement, Treasury yields have declined. For the 30-year yield, now below 5.2% from over 5.3%. Do you see a direct cause and effect between what Bessent did and the yield action?
Yeah, sure. Thanks so much, Scarlett, for having me on today. Definitely an interesting moment right now, and there's a lot of competing factors going on right now. So yes, I think that Bessent's actions certainly helped, in the short term, but what he's really doing is addressing more structural and plumbing. But he can't really fix what's happening, and what we see are the bigger factors at play here, which is, structural deficits that we're dealing with and Treasury supply that's increasing. So he can move the furniture around, but not necessarily change the greater picture, which is really what is at stake right now.
Okay, and so to that end, Stan Druckenmiller, who is Scott Bessent's mentor, published a scathing op-ed. He wrote, with the assistance of AI, that the bond market wasn't being a vigilante, as some would argue. It was being a pushover that had finally begun to clear its throat, and Treasury moved to quiet even that. So, Noah, let me bring you into this conversation. Are we gearing up for a battle between bond vigilantes and Treasury?
I think what we're starting to see is the market pricing risk more appropriately. I think as one of your previous guests, they talked about, if the long bond approached 6%, then I think that we have a problem. But 5.25% on the long bond, we don't think is offsides relative to some of these factors that Kelley mentioned as well in terms of the supply and the deficit challenges. So we don't see a big issue with the market being offsides. We view this as a reasonable response to the underlying fundamental and technical factors.
Scott Bessent announced an intention to purchase. That's what I find interesting. The Treasury hasn't actually done anything yet, and it's not scheduled to start, I think, until sometime in September. So, Kelley, does Treasury actually need to follow through with anything, or is just talking about planning to buy sufficient?
I think that's interesting. The timing of the announcement is almost more important than the announcement itself, in that it is more of a reaction to what we're seeing in the rising term premium. And the Treasury is saying that's not tolerable right now. So you have all of these competing dynamics, within the market, for the Fed, for the Treasury. And what I think is most important for fixed income investors, though, is to really step back and look at yields. So starting yields matter the most. And so given the complexities of what's happening right now and the competing messages from the data, you don't really need to figure all of that out right now. What's different right now is that you are being paid more to take that uncertainty for that duration risk, and the market is speaking about that. And that's reflected right now in these very high real yields, which I think is the most notable thing to pay attention to.
That's interesting that you don't need to have a macro call to take advantage of that. So let me stick with you, Kelley, because until a clear picture does emerge, and we don't know when that's going to be, where do you want to be on duration? What specific opportunities do you see?
I don't think that you need to make a big macro call right now to like fixed income. So right now, in terms of our duration positioning, because of all this uncertainty, we are more neutral. We're more neutral because we're being paid to wait right now. So you can let the income, let the yield do more of the work for you. And in terms of looking at your total return potential, there's a very high correlation between starting yields and that total return. So we are being patient, we're staying neutral duration, we're picking our spots and being selective and doing what we do best, which is more focusing on the bottom-up fundamental side and staying higher quality.
So let me bring that to you, Noah. Where do you see the opportunity, not just in the U.S. rates market, but globally?
We'd agree that interest rates at these levels are pretty reasonably priced. We do think the market is really charging investors an appropriate premium on the long end of the curve. As we talked about before, there is more risk there. We like the front end of the curve. The market came into this year expecting the Fed to cut. We acknowledge that cuts are unlikely. But we would not agree that that necessitates the Fed raising rates. The market is pricing in hikes into the curve in the future. We think there is an opportunity there to take advantage of some of these short end yields in the U.S. Globally, there are a lot of opportunities as well. Real yields are high, not just in the U.S., but in a number of developed and emerging markets around the world, some in Western Europe, some in Latin America in emerging markets. So I think it's important that investors recognize there are a lot of opportunities. It is not just the U.S. fixed income market. The global fixed income markets provide good value as well.
Noah, you mentioned that you like the short end of the yield curve. With Treasury due to increased buybacks of longer-term debt, that does mean more issuance of shorter-dated debt. How disruptive would increasing issuance in the bill market be across the U.S. Treasury curve and perhaps even to what the Fed does next?
I think that is ultimately the Treasury responding in part to where the demand is. We continue to see massive amounts of cash moving into that front end of the curve. You can see that in the total amount of money market funds that are outstanding. There is a lot of demand for this front end yield, and we think that will continue. So we don't expect that to be disruptive. And then the other thing I would say is I do think that part of the timing of the Treasury's announcements around these programs maybe have to do with what we're going to hear from Chair Warsh here coming out of Jackson Hole, as well as the Fed maybe starts to move away from being as interventionist in the market and the Treasury becomes more interventionist.
Kelley, what are you anticipating to hear from Chair Warsh when he speaks tomorrow?
We're all focused on Jackson Hole. Obviously, it's the next important near-term catalyst for Fed expectations and rates and duration. But quite frankly, I think the market's going to be disappointed. There's a lot of questions out there, and the questions just keep mounting. Not the least of which is what was just announced by Treasury. So the bar is very high to satisfy the market curiosity. So it's not that I think that Warsh is going to deliver an overly hawkish message, but I think that Warsh is going to deliver exactly what he has promised, and that is less.
Less or perhaps nothing if you are counting on some kind of direction from the Fed chair. Thank you so much. Yes. I want to really appreciate Kelley Gerrity of Morgan Stanley Investment Management coming in, as well as Noah Wise of Allspring Global Investments joining us as well. Still ahead on real yield, Thoma conceding 40 deal sweeteners following debt talks, and some who are watching the industry say that was an easy deal in the sector. The latest on the software debt market and the refi wall, which that's coming up. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for a moment of interest. With markets increasingly skittish about anything vulnerable to AI disruption, lenders, including BlackRock and Invesco, are in a position to demand more in return for loan extensions. In one instance, Thoma ended up conceding 40 deal sweeteners following debt talks. Bloomberg's Rachel Graf has more on this story. And this has to do with the wall of maturity that's coming up. PE firms have more than $55 billion of software debt coming due over the next 2 years. Tell us what Thoma Bravo has compromised on to pave a path for refinancing software debt.
Sure. So no one really knows where artificial intelligence is going to be several years from now. So for lenders to get comfortable with these software credits, Thoma Bravo is having to make some concessions. And what they've done so far, there's a few things that lenders are asking for. One is more frequent and more extensive financial disclosures. These are privately held companies. They don't typically have to disclose their financials. Lenders are asking for that now. They're also, a lot of these debt deals so far have just been to extend the debt for 2 years. So people have a better sense of where the debt will be in a couple years from now than, say, 10 years from now. And then the third thing is more protections in the event that the debt eventually restructures.
How unusual is it for investors to get 40 creditor-friendly changes to the deal documents? That sounds like a lot.
It is, and the tides are definitely shifting in lenders' favor. For the past several years, private equity firms have had a lot more power at the negotiating table, but because of where software in that industry is right now and all the concerns around it, they are able to make some demands for the first time in a while.
So what does your reporting show in terms of what people think will be the path forward? I mean, does this kind of set the template for how other private equity firms, private credit firms manage things in these deal talks and these debt talks?
Yes, so these were the first software refinancings to get done since the dislocation earlier this year. So the rest of the market is looking to them for a bit of a playbook on where do we have to be with pricing, where do we have to be with terms to get these done. That said, these are some of the stronger software companies that have come to the market first, and so it remains to be seen what will happen with maybe some of the more challenged credits.
Oh, interesting. How much longer do you think we'll have to wait for those deal talks, those debt talks to come to fruition?
Not too long. After Labor Day, I think things are supposed to pick up a little bit. So maybe just a few more weeks, and we'll see, what happens then.
All right, Rachel, thank you so much, Rachel Graf, for bringing us this story. And of course, it's something that we'll continue to monitor because still ahead is our credit roundtable. We're going to speak with Andrzej Skiba, head of BlueBay U.S. Fixed Income at RBC Global Asset Management, and Kyra Fecteau. She is Managing Director and Fixed Income Portfolio Manager at Wellington Management. This is Real Yield on Bloomberg.
I'm Norah Mulinda. Let's take a look at your midday movers. First up, a rally in Nvidia pushing stocks higher, with the Nasdaq 100 leading gains on confidence that AI spending still has room to run. Nvidia shares climbing after the company said revenue will grow about 70% next fiscal year, shattering estimates for a 45% jump and easing concerns that AI spending is losing momentum. Meanwhile, Salesforce climbing for its best day in 6 years after a strong revenue outlook and an expanded partnership with Anthropic, reassuring investors that the company can compete in this AI era. And finally, HP shares falling as investors question just how much demand is left for PCs and printers. Those are your midday movers. I'm Norah Mulinda.
When a firm called Cox Capital Partners had a $15 billion redemption backlog from private credit funds, it offered to buy shares in a bunch of these business development companies managed by the likes of HBS Investment, Apollo, Ares, and Blue Owl. Cox ended up drawing less than $5 million in orders from investors, signaling investors' limited appetite to exit. Bloomberg's Olivia Fishlow joins us now for more. So what does this tell us, Olivia?
Yeah, so we've obviously seen redemptions have been a huge story within private credit. Investors have been wanting their money out of these private credit funds, and they've been unable to get their money out. And so what Cox Capital did is they offered to give them their money back, but at a discount. So they'd buy their shares, but investors wouldn't get the full value of what they had bought. And we saw that investors weren't really interested in taking that discount. So I think it shows that investors, they would rather stay in these funds, and they would rather be blocked than lose some money.
Then why go in for the redemption anyway? Why ask for a redemption? Why ask to withdraw some money?
I think they still ultimately want their money out, and they want to allocate to other asset classes that maybe have seen or are seeing better returns than private credit as of late. But I think for them, their calculations, they just decided, taking a 26% haircut didn't really make sense at this time.
They want the money out, but not that badly.
Exactly.
Are there a lot of firms like Cox Capital out there kind of offering this service to be able to let investors liquidate, but at a cost?
So we've definitely seen some firms that see the opportunity to buy some shares and get investors out. Earlier, we saw Saba kind of launch the same offer as well. And I think when there's a time where these type of funds are prorated, you do see these secondary buyers pop up, and they are going to continue this offer going forward.
So these BDCs typically cap redemptions at around 5% of the fund's net asset value. And we've seen a couple of quarters where the redemption requests have come in. Are we anticipating that to continue? I mean, for the next earnings season, is that going to continue to be a theme?
I think we do expect it to continue because there is such a backlog, the $15 billion, that those investors are going to want to try to get out again and rejoin these queues. But I think we do expect the redemption requests to start to slow down as investors kind of work their way through the entire queue.
Interesting. Okay, so Cox Capital may very well be kind of the beginning, just the tip of the spear.
Could be. We'll have to see.
Fantastic. Thank you so much, Olivia. Really appreciate your joining us on this story. I had not heard of this before, but we'll keep watching this space. That was Bloomberg's Olivia Fishlow. Coming up next, we've got the auction block. Investment-grade debt issuance is at a record for the month of August. I believe that is the third straight monthly record. But Wall Street is finding it hard to pin down exactly how much of a blockbuster month September will be. September, typically a huge month for issuance. We're going to dig into all of that next. And here is a glimpse at what yields are doing right now. The 30-year yield, which of course got a lot of people's attention, including treasuries, up now to 5.18%, just marginally higher. The 2-year yield, a little change to higher at 4.21%. This, of course, before Fed Chair Kevin Warsh speaks tomorrow morning. And a quick glimpse at the equity market as well on the heels of Nvidia's blockbuster earnings. You can see the Nasdaq 100 gaining 1%, the S&P 500 adding 0.6%. So bonds are down, stocks are up. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance so far this week. And it's been a quiet week here in the U.S., so we're going to turn our attention to Europe. Wednesday marked the region's biggest day since June, as 20 issuers sold 25 tranches in a spurt of activity following the summer holiday season. Meanwhile, SoftBank is talking with investment banks about a potential $10 to $20 billion bond offering. Bloomberg News reporting it would help refinance a loan for its investment in OpenAI. The offering could be denominated in dollars and euros and could come as early as September. And looking ahead to September, there's a wide range of forecasts for corporate bond issuance, with some expecting U.S. high-grade issuance to reach $250 billion. That would be a record-breaking September, the busiest ever by volume. And earlier this week, Kelsey Barrow of JP Morgan Asset Management was on Bloomberg to discuss her expectations for what issuance will look like next month.
I've talked to our credit portfolio managers, and they've said $250 billion is not really an issue for us. But we would like to know what we're going to prepare for. Are we preparing for 175 or are we preparing for 250? There is a possibility that we get into September and actually this demand goes fine. And then there is going to be a rush back into the market.
Let's dig into all of this with our credit roundtable. Kyra Fecteau is fixed income portfolio manager at Wellington Management, and Andrzej Skiba is head of BlueBay U.S. fixed income at RBC Global Asset Management. So Kelsey Barrow talked about $250 billion, but actually the range is pretty wide, from $175 billion to $250 billion. Andrzej, is that high end of $250 billion going to cause indigestion in the market?
I think what matters is the spreads at which these deals will come. Because if issuers are forced to leave a substantial new issue concession, repricing the rest of the market, that will cause trouble for the market. If the demand is there and you manage to get away with murder and issue deals with very little concession, it could be a quiet month. But a lot of investors are looking beyond September and looking towards 2027 and thinking, okay, if we absorb September, how on earth can we deal with maybe even 500 billion of AI-related issuance that will hit the markets in 2027?
So how are you thinking about it, Kyra?
Yeah, I think the point about size is important, but we also have to think about structure and the types of deals that are coming to the market. We want to make sure we're getting paid for the risk, and what the market's not saying, no, we don't want any more supply, and we know a lot of the supply is going to come from the AI channel. No, we don't want any more AI supply. It's that the market's open. There's capacity for us to take the supply, so long as it's structured appropriately, so long as that you're aligning the risk with the market pricing.
So, Kyra, you want better terms on these debt sales. You talk about having it structured correctly. How much leverage do fund managers really have when everyone has money that they need to put to work? Order books are really massive, and they're going to stay massive.
Yes and no. I think that the market's already spoke with its feet, right? Because spreads have gotten a lot wider. We're anywhere between 20 and 70 basis points wider on high quality hyperscales, and the data center backed deals that have come with hyperscaler guarantees are down anywhere from 2 to 5 points in the investment grade market, with much more dispersion in the high yield market. So the market's already saying we need to pause and revisit how we're approaching issuance, and it's not necessarily leverage, it's not necessarily capacity to be able to absorb more of this paper. It's if returns are so good for these hyperscalers, north of 20-25%, why should we as investment grade bondholders, as high yield debt buyers or securitized investment buyers, take such little spread and all of the tail risk? And it's the tail risk that's really important for the market to price in, because it's significant.
You know, I think about the secondary performance of some of this hyperscaler debt, Andrzej. How much does that matter to you, that secondary performance? Because it doesn't seem to matter a whole lot to the hyperscalers who have issued that debt.
I think it matters because a lot of investors were hoping that once we pass waves of issuance, market finds its footing, and that has not been the case. AI has been a bust for fixed income investors. You can see in equity markets that a lot of investors made money in AI. In fixed income, that has not been the case. So we now want to be paid more for the risk. And that's why I think investors will be much more selective which structures to support and how much concession do we need to get paid. The recent phenomenon has been investment grade rated deals that are coming at high yield valuations. Now we're talking. Now we're at the point where you can see that as an opportunity. If you've done your homework, if you understand the risks involved in each of those structures, then you get entry points that are much more interesting for fixed income investors, rather than being essentially used by hyperscalers to fund the ever-increasing capex.
Yeah, we're seeing how some companies are increasingly turned to junk bond investors to help them raise billions, even for debt that is rated investment grade. I'm thinking about BlackRock, for instance, looking to finance data center projects. Does this create any risks, Andrzej, for either issuers or investors?
Absolutely. The biggest risk we find outside of the individual securities and the structures that they're issued around is to do with timing. We're having a lot of 5 non-call 2 deals that are expected to be called in 2 years' time when the projects are built. But the more you issue of those kind of bonds, then the market might not be able to refinance these bonds in 2 years' time. And that was such an assumption for a lot of investors within the high yield market, almost seen as a foregone conclusion that once you build it, it will get an investment grade rating and you can issue there or in the securitized market. And that might no longer be the case the more we issue and the more of companies rely on that non-call 2 structure.
How much of the AI issuance, Kyra, do you think will be diverted to euros, to Swissies, to yen, and other currencies as opposed to US dollar credit?
Well, there's about $1.4 trillion of capex expected in the AI hyperscaler build-out space. So, and we've already observed that no single market is going to be able to take on that type of capacity. I find it quite peculiar that you have issuers coming in the investment grade market, in the high yield market, and the leveraged loan market, and the securitized market, because once they've saturated one, they're moving off to another, but the deals don't look any different. And each of those markets actually serve a different purpose for fixed income. And so the way I view it is that stabilized assets belong in an investment grade market. Assets with more speculation and that haven't even been built or specced out belong more in the high yield market. And I think that's the discipline that the market's actually arriving more towards. But we have to spread these opportunities out more broadly for the capacity to be there.
Andrzej, you said AI has been a bust for fixed income investors. So how do you hedge your portfolio? Are you using credit default swaps? Or you have another creative solution?
So it's fair to say that credit default swaps have been a really good way to protect portfolios, as investors realized that exposure to these issuers, the size of the financing pie will get bigger and bigger, and we've seen CDS spread widen meaningfully. But the main way we approach that is essentially you have to be light on your feet. Do not put all your eggs in one basket, buy huge amounts of any particular deal. The ones that you like, where you paid for risk, where the structures are strong, buy a little bit, knowing that there are a gazillion other deals coming over the months to come. So as long as you pace yourself, you get better entry points and you can survive this wave of volatility and issuance.
Yeah, 2 weeks ago, the attrition level reached, I think, 45% as investors pulled over 1/3 of their initial orders for investment-grade bond sales. And that could be a sign that investors are getting pickier about what they'll buy and at what price. Have you been cutting or withdrawing any of your orders, Kyra?
So as a multi-sector investor, that's not benchmark relative. My option, I don't have to invest. I can speak with my feet and just not do that particular deal. And I would say that we are being very selective. I think the ecosystem that's set up right now puts a firm like Wellington in a really unique and advantageous position because, like I said before, the deals that are coming to the investment grade market are not investment grade like credit we're used to seeing that a single corporate credit analyst is supposed to invest. What it really is there are real estate fundamentals, there are structured fundamentals and expertise required. And what we've been doing is building out or bringing together all that expertise that we've already had to come together to really properly risk-based price these deals. And we'll decide the ones that command the good price, we'll invest in. The ones that we won't, we just don't.
Yeah, you just wave off. Andrzej, there's increased public opposition to data centers construction across the nation. We've seen that. At what point does this start to matter to the credit market? Do you see it showing up in any way in credit markets?
I think it already matters a lot because we're hearing that some of the projects that could be built further down the line are being accelerated to be completed or approved before the next presidential election. So the pace of capital expenditure spend is driven by some of these concerns. Investors have to look at the power markets to understand whether there could be pressures for specific projects in terms of delivery of power that could impact these specific bonds. And we've already seen a couple of examples of litigation coming our way on that front. So this market demands a lot of homework from investors. It's not just like buying your average corporate bond that we used to do for many years. It is essentially project financing. So from our side at RBC, it involves our high yield teams, investment grade teams, securitized teams, cooperating together to try to make sense out of all this mess.
A lot of analysis, a lot of research. Kyra, I'm going to ask you the final question here, and it's a spillover from our earlier segment on what's happening in the macro environment. Will the Treasury intervention in the rates market cause corporate issuers to sell debt faster than they otherwise would have, just to get ahead of whatever volatility may come?
I believe that there is an upward bias in long end yields here. The setup is such that we have a lot of competing demand for capital. We have a fiscal deficit that has no signs of becoming under control, and we have we have an energy supply shock and inflation pressures. And so the market all of those are reasons to believe there's upward pressure on yields. I think the market is so focused on getting through some of this this AI capex funding and a little bit less focused on where else the rest of the debt is coming from, and a lot of that has already been termed out. So yeah, I don't necessarily think that we should be bracing ourselves for a wave of issuance outside of the AI space.
All right, fantastic to get both of your takes. Thank you so much. I want to thank Kyra Fecteau of Wellington Management and Andrzej Skiba of RBC Global Asset Management. And if you want more talk on credit, do check out the Bloomberg Credit Edge weekly podcast hosted by James Crombie. That is available on the Bloomberg terminal and wherever you get your podcasts. Still ahead, it's back to school season and there are investment opportunities galore across higher education. We'll dig into a little bit of what people see as attractive. This is Bloomberg Real Yield.
We're just about halfway through the trading day in New York. I'm Norah Mulinda. Let's take a look at your midday movers. First up, U.S. stocks higher with tech leading the way. NVIDIA inspiring confidence that the AI trade still has room to run. The world's most valuable company saying revenue will jump about 70% next fiscal year, shattering estimates for 45% growth. Not everyone joining the rally, though. Best Buy falling as investors look for stronger signs of recovery. The company raising its outlook on solid demand, but tariff refunds did a lot of the heavy lifting, and that benefit won't repeat. And finally, a check on software. Cybersecurity stocks climbing as strong results from CrowdStrike and Okta lift sentiment across the group. Those are your midday movers. I'm Norah Mulinda.
In this week's Muni Moment, it is back to school, and our next guest says higher education is a sector that needs to be approached with great caution. Margot Kleinman is head of municipal research as well as the portfolio manager at Nuveen, and she joins us now. So when we look at your view on higher ed, there's a lot of structural headwinds. You've got the demographic cliff, you've got obstacles for international student enrollment, affordability concerns. Do all these things lead to higher borrowing, more borrowing?
Well, it's great to be with you again, Scarlett. Thanks for having me here. It's a great question, and it's one that we're thinking about a lot as we invest across the sector. So taking a step back, as you mentioned, there are all of these headwinds that are really coming together right now. You mentioned some of them, and it does lead to investors approaching the sector with a lot more caution. I think back, 10, even 20 years ago, investing in the sector when higher ed was really looked at almost to be a boring, very stable, very, very highly rated sector. Now, when you look at the rating agencies, about 50% of private colleges are rated BBB and below. So that really is just demonstrating the amount of credit risk that there is in the sector now because of some of those headwinds that you've mentioned. I would also add affordability concerns is huge as people are looking at going to college. And so as we're thinking about investors, when we're talking to clients, we're saying approach the sector, approach it with caution, and make sure that you're getting compensated for taking on some of these risks. So endowments get brought up a lot as evidence of an institution's financial health. How critical is having an endowment of at least $1 billion? Does that protect an institution's creditworthiness? So it's so interesting because in the higher ed sector, everyone talks about endowments. And when you look at the data, there's about 150 colleges in the country, colleges and universities that have endowments of $1 billion or more. There are more than 3,500 higher ed institutions in the country. So when you think about those large endowments, it's really such a small portion of the higher ed sector. I will say, though, endowments are really important. And I think that's why higher ed is such a resilient sector, because unlike other sectors of the muni market, think about hospitals, think about long-term care, think about charter schools, think about, even some of the governmental sectors. Higher ed does have these balance sheets. So even if it's not $1 billion, but if you do have an endowment, you can spend off of those endowment earnings. And what it gives an institution is time. It gives them time to implement a turnaround plan, time to grow enrollment, to introduce new programs if that's what they're trying to do.
So it gives them a lot of breathing room, and it separates the higher ed sector into the haves versus have-nots. The haves, obviously, the elite schools with big endowments. For everyone else, the have-nots, it's all about the collateral, and this is what your research focuses on, and that really comes down to real estate. Talk to us a little bit about how that factors in, and also how healthcare plays a role here as well.
Yeah, absolutely. So when we're looking for opportunities in the sector, especially in this have-not sector, and when we're talking about below investment grade or lower investment grade institutions, we're doing a comprehensive analysis of the operating drivers, the liquidity on the balance sheet. But then as a bondholder, you have to step back and say, what is my collateral here? What is bondholder security? We have done deep dives into real estate for some of these opportunities. We're looking at not only the value of the campus, not only the appraisal, but really thinking from a practical perspective, are there alternative uses for these properties? Could this college, if it was facing stress, peel off certain pieces of this real estate and sell it and still have a core operating campus? Because sometimes that's not the case. And so a mortgage is important, but if it's a mortgage in an area of the country with major declining demographics where you're really seeing not a lot of real estate traction, is that really worth something? And so that is what we're looking at when we are participating in these deals in the market.
All right, fantastic, Margot. Really appreciate your joining us and sharing some of your analysis here. Margot Kleinman is head of municipal research and a portfolio manager over at Nuveen. Still ahead on Real Yield, all eyes on Jackson Hole as the economic symposium kicked off today. We're going to check in with Michael McKee, get his final thoughts on what he's anticipating for Fed Chair Kevin Warsh's comments tomorrow. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for our final thought. The Jackson Hole Economic Symposium kicking off today as investors brace for Fed Chair Kevin Warsh's debut speech at the event tomorrow, hoping for more clarity on the central bank's reaction function. Maybe that's a lot to ask for. Bloomberg's Mike McKee joins us now from Jackson Hole, and some of our panelists are saying that markets might be disappointed because he's going to be likely to say less than whatever they want.
Well, that's the dilemma for Kevin Warsh and his staff as they try to figure out what he should say. What's the downside? Does he get a worse market reaction from saying something or from saying nothing? And so they're going to have to decide one way or another. My guess is that he could compromise in the middle by saying something like, yeah, if inflation doesn't come down, we'll use all our tools to make sure it does. But I don't think anybody's going to get any specifics from him on what he plans to do.
And of course, adding to everything, the drama and the intrigue, is the fact that Treasury has been intervening in the bond market as well. Is our understanding, are we working on this presumption that Treasury and the Federal Reserve are working together, are coordinating their actions in any way?
Well, in theory, Kevin Warsh has said he wants to collaborate with the Treasury, but right now Scott Bessent is working against him because he's making it harder for the Fed at this point. If he's buying back stuff on the long end and he's intervening in the markets as he says he is, then he's getting rid of that pure market signal that Kevin Warsh wants to get from the bond market. And at the same time, he may be forcing the Fed to buy a lot more Treasury bills over time if the Treasury is putting out a lot of bills to pay for these buybacks. So it doesn't seem like there's any coordination on this issue.
And, you know, what's curious about all this is that President Trump has remained fairly quiet through all of this, aside from his being very vocal during Jay Powell's term of wanting interest rate cuts. He hasn't said much on this front lately.
No, and what he has said is that he trusts Kevin Warsh to do the right thing. Now, who defines what the right thing is depends on whether you're in the Oval Office or whether you're in a Fed office. But the president is on everybody's mind out here because of the Lisa Cook situation, and everybody's watching Trump's social to see if he tries to fire her again, because then that, again, puts a question to Kevin Warsh that he won't want to answer, and it would kind of be an overhang to this whole conference. So some people are thinking the president might announce it today or tomorrow, or he might wait until next week and let Warsh have his moment in the sun here.
All right, well, we'll see how that all shakes out. And of course, once anything happens, you will be right on top of it. Our Michael McKee, our international economics and policy correspondent, joining us from Jackson Hole, Wyoming, where the Kansas City Fed's economic symposium is taking place. In the meantime, from New York, that does it from us. Join us same time, same place next week. This is Bloomberg.